Hi everyone, this is the 8th of April 2018 and before I look at a couple of charts, let's just round up to what has been a very interesting period because in Jan 2018 we were at several extremes in terms of the put call ratio actually hitting the highest on record. A lot of options selling, so some kind of crazy activity and meaningful divergence between the broad market and the Nifty into the last part of the Jan month, and that led to what has been a pretty dramatic reversal. And you could have seen that coming. If you saw those extremes, then you knew that this is not sustainable because that's been the pattern at least a couple of times before. And only thing is the previous corrections that we saw in say August or in November were not as steep as this one. The August one was pretty steep. The November one was much smaller, but it was also preceded by significant readings in the PCR and the open interest in the options market, especially on the put side. And so those readings led to the long short report that I published in Jan, anticipating something would start on the downside. But let me add that the size has been much smaller than what I would have thought. At the same time, I do think it is a major reversal in terms of the trend, unless something changes right now. That appears to be the best case. If there's any surprise element still in the markets, it's actually the strength that you continue to see on a rebound in the mid caps. We saw that in the first week of March as well, when the Nifty pulled up. The mid caps actually retraced. In fact, I should say in the second week or third week of Feb. So the Nifty rebounded, retracing not more than 38%, but the mid-cap indices did almost 61%. And even now, since we fell below 10,200, I've been anticipating a pullback. And as it has zigzagged the last 200 points down, you've seen mid-caps actually holding out better in terms of the indices. At least those stocks have fallen pretty sharply. And the rebound now that we have seen this, the second week, I think the Nifty has closed positive, and you actually see mid-cap indices, pulling up much more strongly and leading the way than the Nifty. And what I would typically expect in what would be a counter trend bounce, which I thought it is that you would like to see a smaller retracement or more weakness in the mid-caps, which is what typically has happened in say previous bear market. So I think that sign is missing. They're pulling up sharply, which is normal because you get sharp bounce backs in bear market rallies. But the retracements in the broad market stocks tend to be smaller than the large caps, which is something which I think continues to be a miss. Now I'm not sure whether it's only because this has been one of the most prolonged periods of mid-cap outperformance that we have seen on a really long-term basis. For example, each of the previous mid-cap cycles lasted for a couple of years. This has gone on much longer in terms of the time period that you've seen outperformance. Even though the relative strength has remained at the upper end of its range, it's just not turned around till I think now this quarter we are seeing some kind of turnaround, which is why I sense that the reversal has occurred, but the underlying mania has still not gone away, which is why the moment you start seeing some kind of a meaningful up move, I start reading quotes about the Nifty heading to new highs, 11,500 and all. And while the market was falling, there was so much silence, you'd almost think that people were giving up, but that's not really happened. But it's been a steep cut. You've broken below the triangular formation low that was at around 10,033 on the Nifty and gone much below that in the mid-cap or 500 indices. So that steep cut marks a reversal, but you also ended up getting a meaningfully oversold condition. And this month's rally has started off on again, some kind of a similar setup where you have a high PCR and you have lots of options activity and especially selling by riders, which means that they're not seeing any downside unless there's some kind of an unexpected event. They would continue to pressure the market on the upside, and you'd probably see more of short covering. And if you'd seen the article that was published in Business Line, it quoted that you've seen a record amount of FII shorts on the index futures. So that they were very slow in selling throughout this move. In fact, they were out of their long positions almost 6 months ago. They were just not going short till I think in this recent fall. Once we went below the 10,500 mark, they've slowly been adding to the point where by the end of March, or at the first week of April, their readings are now at a record high in terms of the entire data that's available from what NSE has been putting out since 2012. So usually when you get to this point, you get a reversal as FI starts short covering, and at the same time people are buying puts, which is a reflection of shorts getting covered all over again. So I think that's what we are seeing, a short covering rally. You've seen an overnight sell-off in the US markets, though I think it's early to say unless the lows break that the trend is reversed. They're probably just forming something similar, that we are some kind of a ABC pullback. So we'll get you've seen a sell-off, but I think there's also room to recover in the US indices, because at last week's low, the sentiment had really reached an extreme. You had only 10% people polled as traders to be bullish on the US indices. In fact, less than that, was I think 7% and 9% for the S&P and Nasdaq being bullish and everyone else being bearish. So that was the kind of extreme. We are out of that extreme, but you haven't had a meaningful bounce yet. And the volatility remains, even though the VIX readings are now much lower than what they were in the first week of February when you got that first sell-off. So there's actually a divergence in the VIX, which itself can be read into as a sign of a possible move up. So right now we're looking at a short-term uptrend. The question really is how far can it go, and we're going to be tracking that in terms of levels and retracements. But moving quickly to charts, and before I do that, what I should also talk about is the key driving factors. So I've spoken, I think, in most of my podcasts and previous videos about the dollar. And the dollar has been pretty range bound for a while now, and I'm talking of the dollar index. And the debate goes on as to whether the long-term trend for the dollar is up or is it down. I'm increasingly finding the debate being picked up and discussed in the global macro videos and reports around the world, and everyone has a differing opinion. I've had the one that the dollar index would be bearish since last year, and I've been right on that. And those who've not been are now looking at the extreme open interest or short positions that have built up in, say, the dollar itself as a sign that that might be a reversal. But when I look at the wave structure, it continues to indicate that we are overall in a bear market for the dollar. The only possibility was a short-term bounce a little higher, something that has eluded us for a while. Every time I've thought it's possible, the dollar has given up again, and that's what happened on Friday. It looked like maybe you can do a larger C up, but that didn't happen, and again it gave up. And the euro is in fact at a key support trend line of the last 3 to 4 or 5 months. I think from September low you can actually draw a trend line. It's a third time support on that trend line, and so taking that support, it's possible that the euro up or pound up and dollar down moves resume. Most of the strength that you saw in the dollar recently was actually coming from the yen beginning to weaken a bit again, but not the other currencies. Many other cross rates also continue to indicate that there's more dollar weakness than strength. So that strength has not shown up. Probably the INR has been probably the weakest, because its relative movement has been to weaken against the dollar, even as the dollar has weakened against most other pairs, and that's mostly because of the weakness in equity prices. So that brings me back to the point that the dollar, I think, is in a long-term bear market. You may get a short-term bounce up, but it looks like from Friday's move that that move is faltered and might not continue. It's not being able to even go above the 40-day average. In that light, if you start the next wave down in the dollar, it would start putting pressure on most prices eventually. That's similar to what I was expecting in the last 6 months, because and I'm talking about pressure mostly on US related assets, but it has been positive for commodities. The best performing commodities were this year base metals, and I was anticipating a precious metals rally from December. Made several presentations on that. You did get a rally, but after that the move has paused since Feb, and we are seeing a consolidation, and I think that move is could be due to start again if the dollar starts heading down, because even in a period where you have rising interest rates, the dollar falling simultaneously has still been positive for gold prices. So the dollar plays a much stronger role than interest rates do. And when it comes to interest rates, similarly, I was anticipating a pullback in bond yields. That has happened, and now bond yields, I think, have started to slowly rise in the US into what will be a fifth and final wave for the third wave that started from July of 2017. and that should see yields much higher. Now again, that's the other area which is being debated, and so there are two schools. One of them who thinks that these high yields are going to attract more dollars, and the other one, which I am with, and there are very few people on it, is that the falling dollar is actually putting more pressure on the bond and equity in US markets, because beyond a point when the dollar keeps falling, it causes foreign investors who are the biggest buyers of those assets in the last couple of years to start unwinding. They probably did do so earlier in the bond market than they did in equities. They only panicked in equities much later, when the 30-year bond actually broke last year's lows in late Jan, and that's what we saw in February. So I think that trend has resumed, that you see the dollar starting to fall again, and it will probably correlate with falling bond prices. In the short term, it could end up being positive for equities, just like it was earlier. And while the debate goes on as to whether bond prices bond yields can rise or not, I think equities will probably surprise on the upside. But if yields continue to move up as I'm expecting, then probably at some point of time, the falling dollar and its impact on yields will put pressure on equities again. So that's the thing to be watching out for. And for those who don't know, or have read research work, the similarity to what is often discussed, the 1987 crash, was essentially similar, that you had a strong equity market and bond yields were going up and the dollar was falling, and the simultaneous occurrence was essentially the cause of the much sharper sell-off, and that's essentially what we saw in the Feb decline. And if that pattern shows up again, then probably I think that would probably be the key driver for any further market sell-off from here as well, especially from the US markets or global market side. But I think those trends are developing. I don't think we have a reversal in bond prices longer term. We had one shorter term, but not yet longer term. We don't have a reversal in the dollar. And what all that means is that while we've seen a short-term correction because of this correction in the dollar upwards, which means the dollar rose, base metal prices had their steepest correction. So they were one of the best gainers among the commodity pack over the last year, and they've seen now one of the steepest corrections recently. It's still early to say that it's a reversal altogether, because either the 20-week or 20-month average in many cases has held out as support. In crude, the 20-week is being tested. In most base metals, the 20-month is being tested. And some of them have already formed a low which is holding out. I think aluminium was the weakest because of news flow related to the duties that were put out by the US. But there again, I feel that when you put tariffs, it actually has an upward impact on prices. So the moment you put a tariff on, say, a particular commodity or on imports, the price of those goods go up in that particular currency. And so while there has been a short-term knee-jerk reaction, the impact is actually on the upside. And you would say that, well, demand is not so inelastic, or rather so elastic to, price movements. It's driven more by underlying demand for the commodity, or monetary reasons that may have been drivers for these movements. And therefore, simply tariffs would not be the game changer. You saw that even in soya, you had China put out counter duties, and immediately prices fell for a day, and they've mostly recovered. In fact, you're beginning to see strength slowly in the agro commodity space, which I was looking for, more than a year ago. Most of them based out of forming bottoms, but did not take off despite rallies. They've seen corrections and haven't gone significantly higher, but the trend is clearly turning up in one at a time. So if you look at global wheat prices, higher tops and bottoms. Same for rice, same for soya. Coffee is one which is, held back despite the highest on record short positions in coffee. It has not taken off in a rally yet, but could happen anytime. And sugar was the only one that did its biggest rally, I think, among the agro space, and now is meaningfully holding down to the lower end and not moving up as yet. When I do see that happen, I'll write about it, but right now sugar seems to be the odd guy that outperformed on the upside and is now outperforming on the downside. So the other pack which has done well, like I said, precious metals rallied from December as expected and has been consolidating, but there could be another move up, building up once the dollar starts to decline. The big event there has been various indicators that I've written about. So I've written a silver report, I think overnight, which you can find in the long short section, discussing a handful of data points that came all together for silver that could be a meaningful driver there, because it's actually underperformed the entire commodity space, and in fact in its relationship to gold as well. So I think that's something to look at, as always, trying to take a contrarian and differential stand than what most of the market does. So you can find that report online. So that's what we are looking at in terms of the macro factors. Now, when you do get a move up in commodity prices and what is often called a reflation rally, it ends up being positive for markets. And a lot of these moves in the area of tariffs also end up being positive. And all that puts pressure on what can be considered as inflation and become the reason for the tightening of interest rates. That is the center of the whole discussion. And so will the Fed continue to hike rates if we give them enough reasons in terms of inflation data? A lot of the data points have actually been cooling off, and so the markets were looking for a step back from the Fed, but they still not walked away from the idea. And if these prices do continue to head higher, then I guess that direction will remain. Now, one of the main factors for inflation ends up often being oil. And oil is also another big debated commodity, because it ended up with record positions quite a while back when it was in its 50s itself. And at that point itself, the wave count was showing it would head higher. So I continued to project for 60 plus up to 64, 65. We got there. And once again, you have a correction and positions are now even higher. So the question is, what does the wave structure say? So I was looking for a fifth and final move up. We got a push up, but it couldn't get past the 65 mark. So do we have a double top? Now, we haven't broken the key support range, which is at around 61 to 60 on crude. And if that holds out, then I think the up move is still on. If it does not, then we would probably get a reversal in crude, and that could be one of the dampeners to the entire inflation interest rate story that is going on. But I think bond markets will have their own reasons, because what the dollar and the bonds are doing might have nothing to do with what's happening in the oil space, because there's so many moving parts. Look at each one for its own merit. And what I would say is that oil is at an important support, and if it holds out, it would add to the inflation argument on the upside. So and that again sometimes can short term be positive for certain energy related stocks in the US. And so those are multiple internal triggers, but the key one will be whether interest rates find a risk off bid, or they end up being risk on. So what is going to happen to Indian bond yields? Now, you had the RBI meet this week, and RBI, as expected, did not raise rates, and one of the reasons is that the government essentially pushed ahead its supposedly much bigger borrowing program for this year into the second half. So they've actually eased pressure on the bond market and the currency market. So you've seen bond yields cool off, and you probably see the USDINR also cool off a bit. That's probably one of the triggers you could get for the market upside. But as we head into the second half of this year, the borrowing programs will have to be completed. And if you get US bond yields rising at that point too, then it will be double pressure on Indian bond markets all over again. So I think that's what we will be watching out, especially on the second half. Right now in the first half, most people will again go back to concentrating on the possibility of a revival in the earnings cycle. That's something that was discussed in Jan. You had some signs of it. You're going to get some signs of it again now, and the discussion will continue. My long-term view remains contrarian. So here at this point of time, I'm going to start switching on to some charts. But I'll make one last mention from what the RBI mentioned, and they spoke about the cryptos. They said that they're going to ask the banks not to allow transactions in that area, and it's something that I think has been spoken about, discussed. I've written about it on the blogs many times, of course, mostly giving the elite wave outlook. But I also wrote about it when I started, writing about Bitcoin sometime in December, Jan, that it has all the senses of, something not being right the way it was being marketed, using influencers and online ads, that it was essentially being pushed to a larger audience. Now, whenever you're doing that, you're trying to suck in the larger public. It's not a good thing because it reflects, forces that don't have the best interests in mind. And now, with the government backing off on this product, I guess, at least as far as people holding it in India would be looking for exits. Now, there was one interesting question on that, why hasn't the US really backed off? I mean, you've seen China back off, you're seeing India back off, and look at their own cryptocurrency introductions if possible, but not really the US. They've just allowed it to go on, and it's even listed on the futures exchange. So we don't know what the eventual game plan is, but what it does do is that independent issuers of currencies would probably not be a play in the future, and all the work done so far in terms of the technological progress, it would definitely help in building on the technology from here on, but the existing issuers would lose their super high valuations, maybe coming closer to their cost of mining in the months or weeks ahead. So that would be something to watch out for. So with that, what you're looking at on this chart is the Nifty 500, and the reason I've taken the 500 is it had the best trend line fit for the ending structure that you can see here from 2010 to 2018. And I think since 2010, I was saying that we are in a fifth wave as far as the long-term positioning of the index is concerned. So I did believe that a fifth wave had started. I thought it would end much earlier. And so what could have ended in a year or two has ended up being a 5-6 year long affair. And the reason I thought that was what I've marked as A of the wedge was essentially a corrective structure. The entire rise I've always believed was corrective, and for a while I thought probably because it's corrective this is a triangle, and so my closest belief was you get a triangle and then a fifth and it ends, and so I thought the 2015 high was max what you'd get when markets rallied post the Modi election. But after having stretched out beyond that point and beyond 161% of wave D, the only available ending structure is that to take the entire pattern from 2010 to now as an ending diagonal, and rather than a triangle and a fifth. So that wouldn't fit. This would be the best fit, and this is the fifth wave of a super cycle degree. This is what I've been, I think, saying and writing about. There's one variation to this waveform that you can do, that is you can take this as wave 1, 2, 3, 4 and 5, which I'll show you on Nifty. And the reason is that in case of the Nifty, the 1999, 98-99 lows did not break in 2001. And the reason that didn't happen is the way the tech stocks were introduced into the indices. They were introduced in some indices, in most indices late, but in the BSE indices much before the NSE indices. And when the tech bubble burst, then once these stocks were in, they caused the fall to be far more steeper than the upside that you had during the bullish phase for the tech sector. And so their upside did not get captured in these indices, and they broke the 98 lows. And if you actually look at the brick and mortar stocks, or rather the core economy stocks like ACC, Reliance, Tata Power of that time, they all made their first impulse waves between 98 and 2001, and then went into a wave 2 into 2001. So from 98 to 2001, wave 1 and wave 2. And so that structure ended up being the first leg of what has been a long-term bull market since then. And that variation, because of the tech sector, causes you to count it differently. But what's important is that what we are seeing after 2010 has been a fifth wave and ending pattern in my reading. And some people who are trying to count this as 1, 2, 1, 2 in a perpetual bull market, a few people have turned over to at least say it's 1, 2, 3, 4. And even there, then they're expecting that there would be at least one more rally up, because then they believe that this correction that we have seen over the last couple of months is only a fourth wave, and you'll get one last fifth wave up. Now, I'm not really counting on it. while it is possible to argue that wave count, I'm not really counting on this last one possibility. Now this is a chart of the Nifty that you're seeing, and the Nifty has not touched the upper wedge line, and if it does make this final move, then it would end up touching that upper line and do that. But because it's an ending structure and we expect it to be a series of 3, 3, 3, 3, 3, which means on a larger degree of this triangular pattern here and a triangular pattern here, this is a series of 3, this is ABC, this is also ABC. I would like to think that ABCs, 3 series of ABCs are complete, and this pattern is essentially done. So this is Nifty. The Nifty did not break in 2001 below the low that we made in 1998, in late 98, and it can be marked as 1, 2, 3, 4. You can draw a channel around it. And then the fifth wave essentially didn't reach the upper end of the channel. It is truncated, but it's pretty large in terms of size. If you take this entire structure, it's almost equal to the previous move, but still much smaller. But it has been losing momentum because each leg higher has been smaller than the last. So that pattern which we expect to see in ending is pretty much apparent on this, where A is the biggest, C is much smaller, and E has been smaller, and even it manages one more move to a high, it would be smaller. But that's, like I said, I'm not anticipating a move to a high. I think the recent declines have been impulsive or 5-wave. All you should typically get is only a retracement. But the long-term debate continues, because most people want to think that what started from 2009 is a perpetual bull market and goes on forever. And I think that's where my wave counts tend to differ irrespective of how they end up behaving in the near term. So a lot of insight there into the things to look out for in terms of what the market continues to do. We're looking at some potential upside and the key factors to watch in global macro, the bonds, dollar, and commodity spaces, which I continue to write and cover on a daily basis. So I also mentioned the silver report is online, which I've just written yesterday, updated with all the charts, and so you find that interesting. I haven't written another long short report since January because the report should be a market timing report. Although often there's a demand for one to be done every month. Even in between July and August, I did it once in 2 months because the clear reversals longer term were not yet visible. But as and when you did get a sign of a medium term high, I have definitely put it out. But we are still looking at a long term trend reversal rather than a continuation, which is why whenever I've written a bullish reports, it's always been for a pullback, a retracement. Like when we were at 7,900, I was looking at just going back to maybe 8,000, 8,500, 8,800, but not really to new highs above 9,000. But we did get that, and so even after demonetization, I was expecting a move up. We were oversold like we are now. But again, what I'm not anticipating is any kind of a runaway move, but the potential that we're at the late stages of what is a long-term distribution and reversal of a super cycle degree bull market, something that would have started only pre-independence. The RBI was formed in 1934. If you've read my economic winter reports, the reason we take it is from the inception of RBI, you take it from independence. And you're 60 to 70 years into that or more, and that in that sense we are at the end of one super cycle, and that's just the first wave, I think, of a grand super cycle that could last at least three generations, and this would be one of the first super cycle degree bear markets within that that follows once you complete an ending fifth wave long term. And I think that's something that nobody's anticipating, nobody's expecting, nobody believes is possible. And that's why I think it will be a complete surprise to the street. And oddly enough, if the thing that was missing in 2010 when I called a fifth wave, which is now built in, is the widespread participation of the public at large in an increasingly weakening economic environment. Because as you saw recently, the Nikkei PMI is showing manufacturing again cooling off after the upticks in December and Jan in the data. We're also seeing, new capex data points are dropping off sharply. If you saw one of the tweets that I retweeted last week. So a lot of economic data points all over the place, not yet a clear reversal. maximum public participation in terms of mutual fund accounts and broking accounts that have been opened in the last couple of years. And you're at the end of a fifth wave at the super cycle degree. So a period where nobody would really believe what's coming next, but the charts are completely edged on the opposite side of what most people think is likely to happen. So that's all in this update. Thank you.